The 30-year Treasury yield just reached its highest level since 2007. This spike is a symptom of acute policy anxiety. Overlaying the timeline for the Jackson Hole Economic Policy Symposium reveals the bond market is pricing in high-stakes decisions expected at the summit. In a few days, the Federal Reserve will convene here, in the Teton Range, to address a deteriorating macroeconomic baseline. As of August 2026, U.S. economic growth is running measurably below its historical trend. That slowdown is occurring while inflation remains high, with the Consumer Price Index sitting at a stubborn 3.4%. This gap creates a structural collision. The U.S. economy is caught between an activist executive branch and the monetary policy of the Federal Reserve. Specifically, the Treasury Department is initiating aggressive supply-side shocks that directly contradict the Fed's mandate to lower prices. To understand the specific risks to capital markets, including commercial real estate and digital assets, we must mathematically model this collision by mapping July's economic data against the Treasury's dual-front economic war. We start our model with the Chicago Fed National Activity Index, or CFNAI. It uses a weighted average of 85 indicators to provide an objective starting point for growth. This gauge tracks the July CFNAI. The reading dropped to negative 0.08, moving the U.S. economy into below-trend territory. The internal data shows clear weakness. July payrolls declined by 23,000, causing the employment and personal consumption subindices to flash red. In a standard economic cycle, negative growth and a shrinking labor market would trigger rate cuts from the Federal Reserve to stimulate the economy. But the 3.4% CPI reading prevents that. The Fed cannot lower rates to save jobs if it risks another spike in consumer prices. The U.S. economy is exhibiting a fragile stagflationary friction. The Federal Reserve is effectively trapped, leaving the country vulnerable to any new external price shocks. The first shock to our model is the total breakdown of U.S.-Canada trade negotiations. The executive branch responded by imposing a 50% tariff on $20 billion worth of Canadian goods. This flowchart demonstrates the inflation transmission. A 50% tariff block crushes U.S. importers' thin profit margins. The cost spills directly into consumer shelf prices, hitting recognizable categories immediately: electronics, cement, and household goods. The administration did exempt oil, natural gas, and potash. By excluding potash, they temporarily protect U.S. farmers from a sudden spike in agricultural fertilizer costs. However, the threat is compounding. Canada's dollar-for-dollar retaliation is scheduled to begin on September 8th. Ottawa is designing that retaliation to target U.S. dairy, steel, and agricultural equipment. This applies direct pressure to border states, creating domestic political anxiety for lawmakers like Senator Susan Collins. This reciprocal trade war introduces a massive supply shock just 10 weeks before the November midterm elections. Simultaneously, a second shock unfolds in the Middle East. This satellite view of the Strait of Hormuz shows the primary geographic choke point of the conflict. To end the war, Treasury Secretary Scott Bessent has launched Operation Economic Outcast. The campaign relies on secondary sanctions. Instead of targeting only the adversary, the Treasury punishes third-party nations and banks that facilitate Iranian trade. This network map shows the targets: exchange houses in the UAE and Chinese banks financing Iranian oil. The Treasury threatens to remove these entities from the U.S. dollar system. Losing dollar clearing access makes it impossible to pay for vessel fuel, insurance, or port fees. Threatening the solvency of Chinese financial institutions invites severe geopolitical retaliation, forcing a choice between sanction compliance and a complete fracturing of global trade lanes. When financial rails are cut, physical logistics follow. Trade lanes grind to a halt as payment defaults and insurance voids completely freeze global shipping. When we combine the supply shocks from the Canada tariffs and the Iran sanctions, the data points to a unified conflict in the bond market. This brings us back to the Treasury Department. They have begun direct interventions to manage the long end of the bond market. This puts them in direct opposition to Federal Reserve Chair Kevin Warsh. Warsh uses the overnight interest rate to control the short end of the curve, but he prefers the rest of the yield curve to remain unguided by the government. The conflict is distorting the curve. The Treasury is pushing down long-term debt, while the Fed pulls on short-term rates, creating a volatile, kinked graph that strips the Fed of its predictive market signals. Investors realize that the Treasury's trade and sanction policies are highly inflationary. The market has concluded that the Fed will eventually be forced to hike rates steeper and hold them longer to combat this executive-driven inflation. This fear of steeper Fed hikes in the future is exactly what is driving the 30-year Treasury yield to its dangerous post-2007 peak. This data now reaches a crisis point at the Jackson Hole Symposium. Fed Chair Warsh must now choose to either validate the market's inflation fears or publicly push back against the Treasury's activist agenda. While the policy debate continues, the victims of this standoff are capital-intensive sectors, starting with commercial real estate. This dual-axis chart shows the transmission of pain. As the 30-year Treasury yield remains high, the inverse line for commercial real estate property valuations plunges. High 30-year yields guarantee that long-term borrowing and refinancing costs will remain elevated, exerting crushing downward pressure on commercial property values. The second impact zone is the digital asset market. Crypto traders are not expecting a rate pivot at Jackson Hole. They are hunting for specific cues regarding global liquidity. Bitcoin operates as a sensitive macro asset, reacting directly to dollar strength and the tightening of financial conditions caused by this clash between the Treasury and the Fed. The primary macroeconomic risk for late 2026 is a policy-induced stagflationary environment. This is a crisis born from the grinding collision of executive trade warfare and central bank mandates.